Hello, very good morning to all again. This is Kelvin Wong here again, the Senior Market Analyst of OANDA Asia Pacific. Good morning and welcome to today's Daily Dose of Market Insights. Today will be Tuesday, the 16th of April, 2024. So before we start our Daily Dose of Market Insights, as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the short-term technical outlook of the various broad-based cross-asset classes, let's have a recap of what has taken shape yesterday in terms of the performance of the markets. Markets, what I mean is the global markets, that means ranging from the major stock indices, the major FX pairs, as well as the two key commodities that we covered on a daily basis. That means gold, XAU/USD, as well as West Texas crude oil, and as well as the key data or events that has been released yesterday, and as well as today Asia session right before the start of our daily dose, and their potential impact on this we call it a movement of the broad-based cross-asset classes. So let us start off the performance of what happened has taken shape yesterday. So yesterday there was actually the release of one key US economic data, which is the retail sales. So if you look at my screen over here, retail sales actually managed to beat expectation. Okay, let me very quickly. Okay, so if you look at my screen, retail sales over here. Yes, okay, US retail sales. So US retail sales on a year-on-year basis actually surpassed expectations. So markets are expecting around 2.5% year-on-year to 2.7% year-on-year for the month of March. But however, it actually almost doubled in terms of growth. So retail sales came in at 4% year-on-year, surpassed expectation, and also above 2.1% year-on-year that is printed in the previous month of February, pardon me. So if you look at the trend, the retail sales year-on-year growth trend, all right. So if you look at the 5-year trend, okay, so it's slowly actually inching upwards. All right. So 4% year-on-year for the month of March. That is actually coming close to the highest figure since February 2023. So that's about an 11-month or so high, or much high. So what we could see over here at this point in time is that it's indicating to us that the US consumer spending, because retail sales relate to consumer spending, is still pretty much resilient in the US economy. So with a resilient US consumer spending, and bear in mind that the economic growth in US is not really dependent on the external economy. That means it's not an export oriented country for now, for sure. Close to 3/4 of the US economic growth on the average in the past 20 years or so has been driven much more on consumer confidence and consumer spending. So with a resilient retail sales, we call it a growth figure for the month of March, which translate to robust consumer spending in the US economy. That actually means that the US Federal Reserve is pretty much justified in the last 2 weeks or so in their kind of indirect guidance from Fed speak. They are actually in no rush of cutting US interest rate, or i.e. to enact the start of the US interest rate cut cycle. So that actually also translates to potentially higher cost of funding. That means the US 10-year Treasury yield, which I have warned last week, once there's a break of that 4.5% key medium-term resistance, potentially it could continue its upward trajectory trend from a medium-term perspective. So if you look at the trend of the US 10-year Treasury yield over here, okay, so very clearly it surpassed that 4.5% level. Okay, so this is the key resistance, medium-term resistance has been surpassed. And yesterday, after that strong or better than expected US retail so much, it actually ticked higher and closed the US session at 4.61%. So very likely right now what we could see is the resumption of that long-term impulsive up move sequence as it continued to trade within this long-term descending channel since March 2020 over here. So the top of the channel is at 5.2%. All right. So with this potential continuation of this bullish impulsive upward trajectory of the US 10-year Treasury yield, what does it mean? It means that longer term cost of funding is on the rise as well. With longer term cost of funding on the rise, there's actually a big chance, a big risk that net profit margin may get squeezed to the downside for US corporation, given the fact that since October last year, US major stock indices has been rising on the backdrop of AI optimism, and also given there's a risk of stagflation risk coming back into the picture due to rising oil prices, given the ongoing geopolitical risk premium that is increasing due to the Middle East tension that is still no signs of abating at this juncture. So with that, this potential linkage actually caused a risk-off behavior in the global stock market yesterday. So right across the board, even the European stock indices, initially it actually opened up in the green, but once the US markets gets into way, all of them actually sold off together. So throughout the US session, markets actually, the major US stock indices all ended with losses yesterday. The SPX 500 and the Nasdaq 100 ended with loss between 1.26% and 1.65%. The Dow Jones Industrial Average slightly better, but still with a loss of negative 0.65%. The Russell 2000 down negative 1.37%. So what I want to highlight later on over here is when I share with you all in the technical outlook, both the SPX 500 and the Nasdaq 100 all yesterday closed below the 50-day moving average. So that actually kind of reinforced this ongoing medium-term corrective down move that is taking shape in the major US stock indices. Firstly, led by the Dow Jones Industrial Average last week, where the Dow Jones Industrial Average has already broken below the 50-day moving average much earlier than the SPX and the Nasdaq 100, which has taken shape yesterday instead. So with a very strong strong upward trajectory in the benchmark US no in the US 10-year Treasury yield. So what does it mean? So that actually also translates to very strong dollar movement as well. All right. So this strong dollar movement, what I could see over here is that right now is inching to retest the key medium-term resistance at 107. So this was the last high, medium-term swing high that was seen in October last year. So a breakout above the 107 level potentially could kickstart another round of what you call it a medium-term uptrend phase on the US dollar index, with the next resistance coming in at 110.30. And this US dollar index current bullish tone is also being supported by fundamentals as well. So what do I mean by that? By looking at the short-term government yield spread with US and the rest of the world. So let me share with you something interesting over here that is taking shape. Where is it? Yes, yeah, this chart. So this particular chart is a weekly chart of the US dollar index at the top. So what I'm actually plotting at the bottom is the fundamental linkage between the relative yield spread between the US and the rest of the world. So what I did over here is a weighted average by looking at the 2-year Treasury yield minus off a simple weighted average of the 2-year sovereign bond years against the major trading we call it partners of the US, German, UK, Japan, Canada, Swiss, AU, and China. Okay, so if you look at it over here in the last few weeks, 1.5 weeks or so, the US 2-year spread against the rest of the world has managed to did a bullish breakout from a symmetrical triangle range configuration. So what does it imply over here? It implies a acceleration of a US 2-year Treasury yield premium against the rest of the world, very similar to previous movement that was seen previously. So if there's an acceleration of this US 2-year Treasury yield premium, you look at the US dollar index, it also shape a very strong bullish up move as well. So what we could see over here is that the previous 2.5 week of movement on the US dollar index, this is a weekly chart, mind you, is actually shaping a potential major bullish basing formation supported by the breakout of the US 2-year Treasury yield against the rest of the world. year premium. So what it means that fundamentally right now, the dollar index is actually more being supported on the upside as well by doing such intermarket correlation. So how does this impact in terms of other cross asset performance? So we know that if the US dollar is getting pretty strong over here, supported by this 2-year year premium that is getting wider. That means, i.e., the US 10-year 2-year Treasury year premium short term is getting wider against the rest of the world. Potentially, some of the exported oriented country may get hit, especially China, Singapore, Korea, Taiwan. So what they're going to do over here is they're going to further weaken their currency to support export growth. So that's what happening over here in the dollar CNH. So if you look at the dollar CNH at this point in time, okay, where is it? Yeah, over here. So this dollar CNH right now is actually testing the key medium-term pivotal resistance over here. So this morning it tests again, but managed to do a pullback. But overall, it seems to us that this ongoing up move here, shaping a series of higher high and higher low, holding above the 50 and the 200-day moving average, is still pretty much resilient. So there is going to very high chance that it might break above this 7.2675 or on the average 7.3 pivotal resistance level on the dollar CNH. That means, i.e., the Chinese authority right now is this, given the fact that we start to see a very strong dollar, the only way to actually prop up growth in China is to have a weaker yen via the external economy. That means hoping to actually boost export growth. And why do I say that? Because the latest data in China right now is showing the domestic economy is not doing that well. Okay, very quickly flip to the economic data released for today, right before we actually start our day, those at 11 a.m. At 10 a.m. Singapore time, China releases a bunch of key economic data. So let us start with the GDP growth first, year on year. So yes, the GDP growth year on year managed to surpass expectations slightly. Expectations expecting at 5%, they beat 5.3%. But the way they beat 5.3% is not through the domestic economy. That means the internal sector of the economy. Why? Because if you look at retail sales, it's actually pretty much in doldrums. Retail sales only came in at 3.1%, mind you, and it's way below 5.5% year on year last month of February, which is being boosted by the Chinese New Year break or Chinese New Year festive season at that point in time, and way below expectation of 4.5%. So if you look at the year on year retail sales trend, so retail sales take it as a gauge of the internal domestic economy in China. So if you look at the 5-year trend, is actually inching downwards, all right, over here. And that is also pretty much reinforced by a very still prevalent, very weak housing market in China. So housing market prices going to tumble down negative 2.2% for the month of March. So you look at the trend over here. Okay, it's very clearly, okay, so if you look at max, is very clearly in a very steep circular down movement. So what you could see over here is that in China, there's this ongoing deflationary risk spiral being triggered by a very weak housing prices. Why? Because housing market is a very key component in supporting, we call it asset-led wealth effect towards the Chinese economy. Then overall, a lack of we call it consumer confidence driven by weak housing prices, that is part of the deflationary spiral, actually dragged down retail sales spending for the month of March. So with a weaker retail spending, what it means that the domestic sector of the Chinese economy is not there to support that ambitious 5% growth target for this year that's been dictated by the China top policymaker. So the only way to achieve this 5% year target set by them for 2024 is through the external economy. So external economy, that means exports. So in order for them to boost export growth further or export demand for Chinese goods in light of this ongoing geopolitical geopolitical tension between US and China, the only way they could do it is from a weaker yen. Okay, so with a weaker yen, further dollar strength coming to picture, it will ignite a currency war against other China exporters that is competing with them for exports. Korea is one of them, Japan potentially one of them, as well as potentially it will affect Singapore as well, being an export dependent country. So currency war coming in also doesn't gel well for risk on behavior. So that could actually add on a further drag to further weakness in global equity. So that is the clear linkage that I want to share with you all in terms of the what happened has taken shape yesterday and its intermarket correlation, intermarket impact as well. And before we jump straight into that short-term technical outlook for today, I want to share with you all, yes, even dollar strength is coming back. That means we start to see dollar strength in Japanese yen. So Japanese yen this morning has plunged above 1.5. No, yesterday's mid Asia mid US session has pierced above 153 level. So 153 level that is close to a 34-year high. That means the dollar against the yen. That means initially most of us had thought that hey, dollar strength coming back into the Japanese yen, that means yen weakness will potentially give a good we call it a positive impact on the Nikkei 225, but unfortunately it's no. So those who have followed my daily dose of market insights for a couple of months back, I did mention over here is that right now weaker yen does not will not have a positive impact on the Nikkei 225. Why? Because right now the Nikkei 225 is trading more in sync with the S&P 500. So very clearly, if I were to share with you this chart over here, okay, so this is a weekly chart of the Nikkei 225. I plot their movement against dollar yen and the SPX. So you notice that the close relationship between the Nikkei 225 highlighted in blue, the SPX highlighted in green, turquoise green, is moving almost in sync parallel. If you look at the last 3 weeks of dollar strength against the Japanese yen, it doesn't translate to a positive movement on the Nikkei 225 at all. All right. So right now, for those who are actually using the yen as a intermarket correlation with the Nikkei 225, that means previously we look at the past relationship where yen weakness translate to Nikkei 225 strength. The answer for you right now, it doesn't work right now. So in order to actually look at Nikkei 225 intermarket correlation, the better market to use is actually the S&P 500. That means, i.e., if the S&P 500 going to be weak, that means key technical elements are showing further weakness in S&P 500. Potentially, it could actually translate to further weakness on the Nikkei 225 as well, despite the yen being on a weaker path against the dollar going forward. All right, so this is another important intermarket relationship that I share with you all. All right, so right now with that, let us now jump straight into the short-term technical outlook. All right, so now let us start with the major stock indices first. So bear in mind, I did mention about the risk of that currency war taking shape. So any China-related proxy index will also bear the forefront of that negativity. So what we could see over here is the Hong Kong 33 index broke below the minor low of 22nd of March. So that's our first support level as well, 16,335. Okay, so before we continue our short-term technical outlook, let me expand my screen so that you guys could see much clearer. All right, so over here, it broke below the 16,335 level. So right now, this level here will be turned into a pullback resistance at 16,335. So I don't want to use this 16,335 over here as my so-called this zone here, which is the 50-day moving average, broke below 50-day moving average. I don't want to use the 16,335 slash 16,440 as my short-term pivotal resistance is getting a bit too tight. So I will tighten it slightly lower, very close to yesterday's high, minus swing high level, which confluence with the 20-day moving average acting as a resistance as well, coming in at 16,655. So I will using a slightly tightened 16,655 level as my short-term pivotal resistance for today. Still maintain that short-term bearish bias on the Hong Kong 33 index, that means the Hang Seng index. Next support level to watch will be at 16,135 slash 16,070. a break below it exposes 15,950, which is the minor congestion area of 14th of February and 16th of February. Only an hourly close below 16,655 will negate the bearish tone to see another round of choppy movement back into that range configuration that is in place since 13th of March. Next resistance level that it may to watch out for after 16,655 will be 16,850, followed by 17,230 level. The German 30. So the German 30 during the European session did a nasty squeeze up, but didn't surpass above clearly the 18,210 short-term pivotal resistance level, which is also the 20-day moving average. So with that, no change. Price action right now is trading much lower, but I don't want to put it so tight at 18,080 level. All right, so I'll still be using 18,810 level. This one has already been surpassed on the downside. Okay, over here, so still using 18,210 as my 18,210 as my short-term pivotal resistance level. Still maintain that short-term bearish bias on the German 30 index. Next support level to watch will be at 17,680, which is close to the 50-day moving average. A break below it exposes 17,420, which is the minor congestion area of 23rd of February to 27th of February. Only a clearance above 18,210 will invalidate this short-term bearish bias to see another round of a counter trend rebound scenario taking shape on the German 30 towards the next resistance at 18,310, followed by 18,395 level. Okay, US indices. So as expected, the US Wall Street going to inch much lower and clear below the first support level at 37,770. So this level here will turn now into a first resistance level to watch for today. Okay, so will be this cluster of resistance here. 37,770, 37,930 level over here at this. All right, but I don't want to use this as a Titan key short-term pivotal resistance. I will tie it to yesterday's high, where we start to hit and shape that surveyed a sell-off during the second half of the US session, 38,340. So 38,340 will be my Titan key short-term pivotal resistance for today to maintain that short-term bearish bias on the US Wall Street 30, which is the Dow Jones Industrial Average. Next support level to watch, 37,390, followed by 37,165. So what's this level? So this level over here, if you look at it, is the very clear graphical support level. All right, from 18th of January to 31st of December last year, which is the 37,165. All right, so only an hourly close above 38,340 will invalidate this short-term bearish bias on the US Wall Street 30 to kickstart another round of kind of a minor another round of corrective rebound scenario to expose the next resistance at 38,660. Above it sees 38,930, which confluence with the 50-day moving average acting as a resistance level as well. The Nasdaq 100. So the Nasdaq 100, if you look at the daily chart over here, is finally broke below the 50-day moving average over here. So right now, right, the RSI prior to that, that is shaped that bearish, very clear bearish divergence. So very clearly right now is already inch much lower, broken below the 50 level, and still has much more room to go before hitting the oversold region. That means from a medium term perspective, that means from the multi-week perspective, right, potentially the Nasdaq 100 could still have much more room to the downside towards the next medium term support level at 17,160 / 16,930, which is this zone over here at this point in time. And if you do the Fibo retracement of this last major rally, is around 38% Fibo retracement. Okay, so with that, what we could see, that means, i.e., from a longer term perspective on the Nasdaq 100, that means what we could see right here now is very clearly the start of a multi-week corrective down move, a sequence potentially taking shape on the Nasdaq 100 based on the technical elements that I shared with on the higher time frame chart. So On a shorter term time frame chart, that means i.e. the short term technical outlook for today, we will still maintain that short term bearish bias, definitely for sure, with a tighter short term pivotal resistance right now, very close to yesterday's breakdown level, which is 17,940. So what you see that after the break of this 17,940, it actually released that very steep sell off that we could see on the hourly chart over here, this long black candle. So for sure, this is a pivotal resistance level to watch out for, and also very close to the 50-day moving average, I think, as a resistance as well. So 17,940, as long as any potential bounce didn't surpass some, so there could be a bounce coming into play. Why? Because it's coming to a first near-term support at 17,650 over here, this minor congestion area, and the hourly RSI is already hit the oversold region, so potentially there could be a bit of bounce coming into play before another round of bearish impulsive sequence unfold. So as long as any bounce didn't surpass this tighten key short-term pivotal resistance for today at 17,940, we will still maintain that short-term bearish bias. Below 17,650 exposes the next near-term support at 17,500, which is the minor congestion area of 21st of February. Only an hourly close above 17,940 will negate this bearish tone to see another round of choppy movement again to expose the next resistance level at 18,180. That was Monday's high. A break above 18,180 sees the next resistance at 18,380, which confluence with this minor descending trendline resistance that is capping previous rebound of 4th of April and 12th of April, right, which is at 18,380. Okay, so Japan 225 before we go. So Japan 225 also plunged down lower as expected, and almost hit the support level at 38,340. So with that, potentially there could be another a minor bounce as well, taking shape. Why? Because the RSI really hit the oversold region on the hourly basis. So first resistance to watch on the bounce will be this former minor swing low of 5th of April and last Friday, where it managed to stage that relief rally before plunging yesterday. So this will turn into a pullback resistance, but I do not want to put it so tight at 38,800 as my short-term pivotal resistance for today. I will instead use the 50-day moving average over here, which is this congestion area here as well, 39,070. So using 39,070 as my tighten key short-term pivotal resistance for today, still maintain that short-term bearish bias on the Japan 225. So as long as any bounce didn't surpass 39,070, still maintain that short-term bearish bias on the Japan 225. Next support level to watch after 38,340 will be 38,130, followed by 37,850 over here. All right, so 37,850 will be the minor congestion area of 14th of February to 15th of February last year. So only an hourly close back above 39,070 will invalidate this bearish impulsive short-term sequence to see another round of minor counter trend rebound scenario unfolding to retest the next resistance level, which is yesterday's swing high at 39,500. A break above 39,500 exposes the next resistance at 39,810, which confluence with this minor swing high of 9th of February, 12th of April, as well as the upper boundary of this minor descending channel, and as well as the 20-day moving average, all acting at a similar level at 39,810 level. So i.e. net overall, we still see signs of bearish elements still prevalent in the short term on the major stock indices, except the fact that there could be some minor bounces here and there, given the fact that all their respective hourly RSI is hitting their oversold region at this juncture. All right, so now FX market. So I did mention that dollar strength is coming back into the picture right now. So let us start with the European currency. So on the European currency, the euro dollar has really tumbled as expected and coming close to the support level that we highlighted yesterday, 106 level. So with that, I will right now use a tighten key short-term pivotal resistance, which is yesterday's minor swing high at 1.0670. Still maintain that short-term bearish bias. So as long as 1.0670 holds in any potential bounce, the euro dollar break down below 1.06 next, which is the support level, will expose 1.0525. What's 1.0525? Close to the lower limit of this descending channel that I drew from the high of 28th of December. All right, and as well as graphically this minor swing low area of 18th of October, 26th of October, and 2nd of November last year. So still maintaining the short-term bearish bias with a tightened key short-term pivotal resistance for today on the euro dollar at 1.0670. Only an hourly close above 1.0670 will negate this bearish tone to see another to see a much more pronounced minor counter trend rebound scenario unfolding that may expose the next resistance level at 1.070 followed by 1.0760 level. Then the sterling dollar. So the sterling dollar also broke down below the first support level at 1.2440 over here. So now this will becomes a first resistance level to watch. So with that, I don't want to tie it so tightly at 1.2240. So I'll still use yesterday's pivotal resistance level at 12520 to still maintain that short-term bearish bias on the sterling dollar towards the next support level to watch will be at next support level to watch will be at 1.2380 followed by 1.2350, the lower limit of this minor descending channel, and as well the one-time Fibo extension level that I drew over here, and from the low of the cluster area of 6th of November last year. Only an hourly close above 1.2520 will negate the bearish tone to see a potential squeeze up to retest the 200-day moving average, also acting as a resistance at 12580. Above 12580 exposes 12650, which is also confluence with the 50-day moving average, acting as a resistance at a similar level as well. Now, Asia Pacific currency, let us start with the Aussie dollar. So Aussie dollar very clearly plummeted as well, given this morning very weak China data. All right, on the retail side and the home sales, that actually causes the Aussie dollar to be much weaker as well, given the close proximity between the Australian economy and the Chinese economy in terms of their export sector. So with that, this 6640 here will be my first resistance level to watch out for. So I don't want to tie it so tightly at 6440. So instead I will use 6460. So it's a zone now, 6460 over here. So what 6460? So if you were to do the minor trend line, taking from the swing high, the rejection off here from that previous symmetrical triangle range resistance. Okay, you put it down here. All right, so this will be the area of confluence. 6440, 6460. So as long as 6460 short-term pivotal resistance is not surpassed to the upside, we will still maintain that bearish bias on the Aussie dollar. Next support level to watch will be at 6390. So what 6390 is the strict congestion area of 14th of November and 25th of October, followed by the very clear key medium-term resistance of 63.55. So what 63.55, if I were to do the daily chart over here, very clearly you all could see this is the minor, the very clear trend line, ascending trend line that is in place since 13th of October 2022, being supported last year at 26th of October, and as well as the swing low area of 4th of October to 27th of October, all conferencing at 6280. 68, sorry, this this is 6280. So this 6350 is actually the minus the swing low area of 10th of November. All right, pardon me, 10th of November, which confluence with the major ascending trend line support that I drew from 13th of October. All right, so with that, still maintain that short-term bearish bias on the Aussie dollar with this support level to watch next. Okay, only an hourly close above 64.60 will invalidate this bearish tone to potentially see another round of choppy counter trend rebound to expose the next resistance at 65 figure level. Then thereafter followed by a break above it exposes 65 to see 65.50 next, which also confluence with the bunch of 3 moving average also acting as a resistance slightly around this level as well, which is the 20, 50 and the 200-day moving average. Okay, now dollar yen. So dollar yen over here continue to actually inch much higher. All right, so coming close to the second resistance that we had at 154.60. So the next resistance that we have for today after 154.60 will be 155.10 level, which is the one-time Fibo extension from the low of 5th of April, project it to the high of 11th of April, and push it down to the low of 12th of April last Friday. So I will use yesterday's low very close to this congestion area here as my Titan key short-term pivotal support 153.80 to maintain this short-term bullish bias on the dollar yen. All right, only an hourly close below 153.80 level will negate this bullish tone to see a much more steeper pullback on the dollar yen to expose the next support area at 153.30, followed by 142.70 level. All right, now spot gold. So spot gold yesterday we flipped to a bearish bias, so still holding that so it actually indeed it went down. It went down and test the first support level at 2,327 before rebounding, and right now it's testing the key short-term pivotal resistance at 2,390. So since there's no break above 2,390 in the last 4 hours or so, this is an hourly chart, so I'll be still using 2,390 as a short-term pivotal resistance level to maintain that short-term bearish bias for this potential mean reversion decline scenario to play out, to revert back to the rising 20-day moving average, given that in the last 1.5 months or so there's a steep rally in spot gold XAU/USD. But however, it got to have an hourly close below this 2,327 today to reinforce this we call it mean reversion decline, corrective decline scenario to play out in gold. So after a break below 2,327, exposes the next near-term support level of 2,300, then followed by 2,270, 2,260, which confluence with the rising 20-day moving average. But however, if we start to see an hourly close above 2,390, will invalidate this short-term bearish bias for that mean reversion decline scenario to play out. Eventually, we got to respect the price action with a break of 2,390. We will start to see another round of bullish impulsive up move sequence to resume for gold to actually retest 2,420, then followed by the next near-term resistance at 2,450 level, which is the 0.618 Fibo extension. All right. Now, that's for gold. Then how about lastly, WTI crude oil? So for crude oil price, we remain bullish yesterday despite the initial sell-off during the Asia session yesterday, and it managed to bounce off right at the first support at 84.90 level over here. So I'll be still using 83.20 as my short-term pivotal support level, which also correspond to the lower boundary of this short-term ascending channel that I drew from the low of 5th of February. So still no change as long as 83.20 short-term pivotal support holds for West Texas oil. We will still maintain that short-term bullish bias on it. First resistance to watch for here will be 87.70. A break above it exposes 89 figure level, which is the upper limit of this short-term ascending channel as well. Only an hourly close below 83.20 will negate the bullish tone to kickstart a round of a more deeper corrective pullback scenario to unfold, to expose the next support area at 80.80/79.20, which also confluence with the rising 50-day and the 200-day moving average. I think it's a support at this support zone as well. Okay, so with that pretty much sum up with the short-term technical outlook that I'd like to share with you all for today. So what's up on the calendar, economic calendar event? So for today, what we have over here is UK. We have some important data, which is the job market data. For UK, we do have employment change data as well as employment rate data out at 2 p.m. Singapore time today. And also over there at 5 p.m. Singapore time, we do have some consumer sentiment, economic sentiment data out in Germany. We call it the ZEW Economic Sentiment Index for the month of April at 5 p.m. Singapore time. And those who are actually paying close attention to dollar Canada, so over at Canada at 8:30 p.m. Singapore time, we do have the inflation rate data out as well. And throughout the US session will be a rather quiet session. Yes, we do have industrial production out in US, but bear in mind 9:15 p.m. Singapore time, US itself is not a kind of a manufacturing economy. That means they i.e. export economy. So I would say perhaps that data may not be a game changer in terms of market movement. Okay, so with that pretty much sum up for the key data to look out for today's calendar. So with that, we shall come to the end of today's daily dose. So do have a great day ahead, and we shall speak again tomorrow. Thank you.